What are some of the latest big changes for 401k platforms in general, plus a conversation about the latest estate and gift tax changes? All that on the program. So we welcome in our audience on the variety of channels that we come to you here on Sunday morning throughout the Central Florida region. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of this week, as we do in this segment, we like to talk about the events that were. Surprisingly, this segment always has some content because every week brings new headlines. And certainly one of the biggest headlines out of this past week was the jobs report on Friday, a 467,000 rise in the number of jobs that employers were reporting for the month. That was several times greater than what was expected, especially in light of the fact that there was, I guess, the third wave or the fourth wave or the fifth wave or whatever wave we're on in terms of COVID, with all of those cases involving Omicron certainly spiking in January. Still a lot out there, that is for sure, but perhaps January of 2022 will go down in history as the month that maybe society's views on COVID sort of really shifted. Maybe society as a whole started to view it as something that isn't going away and life goes on. Certainly when you look at those jobs numbers, that certainly seems to suggest that more and more people were starting the process of sort of re-engaging, if you will. And so certainly an interesting development that time will tell on that. But when you look at the jobs number and think about the background, particularly on the COVID side of things, that jobs increase happened while there was another spike going on in COVID. Perhaps the message there is that maybe the world is, I guess, learning to deal with all of this COVID stuff. Certainly doesn't appear that it's going anywhere. Not some magical end to it where we're going to wake up tomorrow and all of a sudden it is gone and gone forever. This one appears to be sticking around and just something that we all will need to sort of live with going forward. And so when you look at that jobs report number, maybe that's what the rest of society is saying as well. For the week in the market, Dow was up a total of 364 points, about 1%. Broader market indexes, S&P 500, NASDAQ were up even more. S&P 500 was up about 1.5%. NASDAQ up about 2.5%. If you're keeping score of those indexes, you know that the NASDAQ one is the one that's got a little bit more tech companies in it. That's the one that actually has been hit much, much harder over the course of the past month or two. A lot of the decline in NASDAQ actually happened on Thursday. So the fact that it ended with on a positive note for the week, that was particularly interesting given the impact that Facebook, or Meta as they like to call themselves now, had on that index on Thursday. The market was processing Meta platforms or Facebook earnings, which wound up not being as good as people expected. So a pretty significant drop on that. But through all of that, markets actually kind of weathered that. If you're looking at how things have gone so far for the year, about 3.5% decline in the Dow so far since January 1. Broader markets more like 5.5%. A calendar flipped to February this past year, which means that the groundhog, what did he do? Did he see his shadow? 6 more weeks of winter, something like that. I'm not sure that that's a really good meteorological indication of what the weather might be going forward, but obviously Groundhog Day this past week, along with the Olympics started. I'm not sure. It's not getting a whole lot of headlines. I think it's getting met with a big yawn, not unlike what the groundhog might at this point in his life getting yawned at. So too did the Olympics start with probably a bit of a yawn. It seems like once again we've got another Olympics where it's very isolated and there's not really a lot of folks in the stands and things like that. So certainly those were the headlines of the past week. Another headline that I guess is not a great one is that the U.S. debt topped 30 trillion. So if you're thinking of that being a big number, it is. And so the only good news is that of the 30 trillion, we owe 6 trillion to ourselves. Is that good news or bad news? Not sure. But anyway, that the U.S. debt did in fact cross that threshold during the course of last week. In other interesting statistics and headlines, if you will, saw this one, which actually goes very well on the heels of a Wall Street Journal article, along with a new development at our office. 1.35 million teacher resignations in the first 11 months of 2021. Last week, the Wall Street Journal had an article talking about that same development in society as a whole, where a lot of folks in the teaching industry just, tired of the back and forth and some of the chaosness on that front, and having to teach kids on the computer and then having to teach kids in person. And oh, by the way, dealing with all of the parental nonsense. They're leaving. They've had enough. And the article in the Wall Street Journal this past week talked a lot about how employers are viewing that group of individuals, college educated, used to dealing with a lot of different things happening during the course of the day. Certainly managing a bunch of kids and all of that during the day would give you some skill set involving multitasking. So the journal article was talking about how a lot of employers are starting to really look at those folks that are transitioning out of teaching and using them to help meet staffing needs, because you're adding people that are quite well qualified, that have been dealing with a lot and now have an opportunity to change careers, which is interesting because that ties very well into something that happened at our office about three weeks ago. 3 weeks ago. We added another member to the team. So we welcome Jamie to the team as our front office person. The reality is, guess what? Jamie is changing careers. She was a fourth grade teacher for 10 years, and now she has left that environment during the course of the past year. We met her, saw her resume, decided that she would be a great fit. So not only is the great resignation happening on the teacher side, Journal's writing an article on it, and even before the Journal article, we had decided to go down that path. So if you are an employer looking for help, we encourage you to maybe look for some of these teachers. Now, bad news, if you got a kid in the public school system, you might be wondering, who's going to teach my kid next year? That's a problem. Anyway, we'll get back to all of this stuff when we return, but we got to take a break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. So before the break, we were talking a little bit about old Puxatawny Phil, Groundhog Day. If you missed the stats on it, because I couldn't remember whether he had seen his shadow or not. He did see his shadow, and I guess that means like 6 more weeks of winter. Here's the other interesting statistic on the article that I just pulled up online from the Philadelphia Inquirer. Not very accurate. Since 1887, the prediction rate has been correct 39% of the time. So you basically could do a coin flip on it and be slightly more accurate. And then as another follow-up side note, our producer and I were chatting during the break and talking a little bit more about that teacher thing. And that is a development that will have to continue to bear some watching. My producer, Lizzie, and me as well, our mothers were both teachers. And so certainly that has changed a lot over the course of the past few years. And unfortunately, our educational system has turned into glorified babysitting and less to deal with education. Certainly on practical matters. A side note, my kid's taking AP chemistry. And we were talking about what temperature does water freeze at? We're having this conversation, when it was cold, and what temperature, what temperature water froze at. How could you be taking AP chemistry and not know just that basic? Anyway, I digress. Maybe that's not important anymore. I don't know. Anyway, the great teacher resignation is underway. As we were saying, if you are an employer looking for great people, college educated, dealing with all craziness, multitaskers extraordinaire, well, expand your job search. I know we did. We're very happy with our newest hire, Jamie, who was a teacher for 10 years. And so if you're an employer looking for help, that's where to go. If you're a parent with a kid in the school system, not sure what the answer there is. Good luck on it. Perhaps that may mean that you have to spend more time one-on-one with the kids and helping them, instruct them on learning how, what temperature water freezes at. But hey, whatever. Anyway, welcome to the program, Dollars and Cents. This is Joel Garris, Nelson Financial Planning. That's where I am during the week. Here on Sunday mornings, we're in front of a microphone. So we get to talk about whatever we want. Usually we try and make it somewhat financially related. On that front, we will give you a couple of different statistics and also take a minute and talk about the week ahead, as we've just finished chatting a little bit about the week behind. If you're keeping score for Washington these days, here's the latest stat out of Washington. The current session of Congress, 117th Congress, running from January the 3rd of 2021 to January the 3rd of 2023, so about halfway through, has passed only 81 bills so far with a year to go. That is, in fact, the fewest number of bills passed in any two-year session of Congress going back to 1973. 284 bills were passed in that session, so well on track to come in under that. That really kind of makes you wonder what those folks are doing up there. The answer is doesn't seem all that much. Other interesting stat is that the largest individual stock in the U.S. reached a valuation of $3 trillion. 40 years ago, the entire market capitalization of all stocks in the world, 40 years ago, all stocks in the world, market capitalization 2.7 trillion. So now you've got one single company that is worth more than the entire global market capitalization of 40 years ago. That's how much things have changed over the course of the past 40 years. Thinking about the week ahead, it is earnings season. Earnings season continues. That obviously allows investors to see how companies are doing or have done for the prior quarter. So it'll be the fourth quarter of last year. What's interesting is really more the commentary about what they expect for the future. That's certainly been a little bit all over the map. We were talking in the last segment about how there was some disappointment involving Facebook, saw a big market reaction to that on Thursday. Looking ahead here locally, Disney's earnings come out on this coming Wednesday as well. Also on Wednesday at the office, we're doing one of our investor conference calls where we've got an investment individual who will be joining us and our clients. I think that's scheduled for 5:30. Yeah, 5:30 on Wednesday. An opportunity for our clients to kind of hear the latest and greatest from folks that are intimately engaged with managing money and investing that in the individual companies that make up part of the portfolio of the funds that we use. So a good opportunity. We typically do those throughout the year along with our regular face-to-face, in-person quarterly educational events as well. Obviously big fans of educating folks. We find that particularly when things get more volatile, that the best response is a little bit of perspective along the way. That helps to maintain consistency with one's investment. So we got one of those conference calls coming up on Wednesday at the office, and then globally Thursday, there's going to be the CPI, Consumer Price Index, basically inflation data coming out for the month of January. So all kinds of stuff going on, along with the fact that if you're keeping score on crypto related criminal activity hit another record high for last year, a total of 14 billion in crypto crimes, or the value of crypto crimes, 14 billion, up 79% from a year ago. So certainly on those platforms, you need to be quite careful on fraud and thievery. And the reality, of course, is you don't know who's on the other side of the transaction that you're doing. And more likely than not, it could be some place that you might not want to support, like, North Korea, Iran, stuff like that. Anyway, so let's shift some gears and talk about the landscape that has changed on 401ks and 401k platforms for this year in particular. Each year you see lots of changes that happen involving retirement plans, retirement accounts, things like that. We're going to talk specifically today about some of those changes that are happening inside of 401k platforms. And perhaps to summarize it, there's sort of three major changes and maybe one potential lurking out there that we wanted to kind of inform people of on the program today. So number one, and you know if you listen to the program on a regular basis that we're going to have a pretty strong opinion on this, but number one on sort of the list of changes that are happening on 401k platforms is that you are seeing a big annuity push. Okay, big push on that. Not only seeing that at the Florida retirement system level, but throughout 401k platforms. So here's what happened. The Secure Act passed a couple of years ago, did a bunch of things like eliminating the stretch IRA and increasing the required minimum distribution age to 72. It also changed the liability for employers to offer annuities by providing safe harbor areas that employers could use if an insurer eventually goes bankrupt. Why is that important? Well, the guarantees of an annuity are always guarantees not of the federal government, but of the insurer who's issuing out that contract. So one of the issues on 401ks is that employers always reluctant to sort of offer annuities because you have that added risk of, well, what's going to happen with the insurer? Well, the Secure Act loosened up that liability, provided a safe harbor. So you're seeing a bigger push into the annuity side on 401k platforms. I guess that just means that the insurance industry, pretty powerful lobbying entity up in DC. We're going to take a break. When we come back, we're going to talk more about these changes on 401k platforms that you need to be aware of here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the three major changes that are happening inside of 401k platforms this year, plus one potential change as well that could have some pretty significant impact. Before the break, we're teeing up that first one, the notion that annuities are much more regularly available inside 401k platforms. That thanks to the Secure Act, which basically provided a safe harbor, allowing employers to offer said annuities to their 401k participants without as much fear of liability as possible. Basically, the Secure Act loosened up any potential liability that the employer might have if the insurer of said annuity contract goes bust. Remember, the guarantees in an annuity are just simply those that are made available by the insurance company that is issuing the contract. An annuity is not a federal government guaranteed type of product. So understand why that change and that loosening of that liability then brings onto the table this conversation about annuities, because it actually sort of dovetails very much with the conversation that we had 2 or 3 weeks ago on the program involving target date funds. So this notion of annuities available inside a 401k is meant to pair with target date funds because, as we've talked about many times before on the program, those target date funds aren't really designed to get you to or through retirement, if you will. They are designed sort of to get you to retirement, but based upon the research that we shared with you all a couple of weeks or so ago, they really operate and go too conservatively too early. And that research out of MIT really sort of confirms that when you're picking one of those target date funds, it shifts much more on the conservative side much earlier than it should. Well, to take it one step further, I guess a further recognition of how well or how poorly those target date funds work. Now they're only compounding the problem by rolling in an annuity option that's going to get paired with these target date funds, and so consequently you can shift from your target date right straight in to the annuity. That's like, getting out of the pan and jumping straight into the fire. The reality is that if you think about kind of some of the numbers that you would hear, particularly on the annuity front, they're saying, oh, well, we'll give you a guarantee income starting at 65 of 5% of the amount that you give us. So we'll guarantee 5%. That's the spiel, right? Except when you put a little common sense to it, okay, I'm 65. Average life expectancy, about 20 years. I think women it's 20, men it's 18. Sorry, guys. The reality is then at 85, if I got 5% per year, and I do that for 20 years, 5 times 20, that's 100%. So if I live my normal life expectancy, then I basically get back the amount of money that I put in. So I go 20 years with zero profit, right? But you got a guarantee of 5%, except, wait a minute, the guarantee of 5% is not a rate of return. It just is for the first 20 years of that proposition, that is simply your money going back to you. That's not a particularly good thing with inflation and taxes and all that kind of thing, right? But hey, insurance lobby, very, very powerful. They were able to get this provision in the Secure Act and then open up a world of other customers now on 401k platforms. If you haven't figured it out based upon our tone, don't go down that path. But that's the latest. You're going to see more and more of that on employer-sponsored retirement plans. One of the biggest examples where we see that is actually within the Florida retirement system. They're really pushing it every single quarter in their investment plan newsletter. They're talking about annuity, and how you can get a guaranteed income. Well, it's easy to get a guaranteed income if you're just getting your money back that you gave them for the first 20 years. I mean, shoot, who can't figure out a way to make those numbers work if I'm the insurance company, right? I mean, if I'm giving you 5%, I don't have to worry about making a profit for 20 years on the amount of money that you gave me. I mean, come on. Anyway, so powerful lobby, insurance industry made that change. Number two is a pooled employer plan. Now, this one actually is not really too bad, because what it does is the Secure Act created a new kind of retirement plan called a pooled employer plan, a PEP plan. And so what those are is those are centrally administered 401k plans that can be joined by multiple unrelated employers, allowing businesses to sort of outsource that plan, particularly helping smaller employers. Because one of the statistics that we see on the 401k front is if you're a big employer, 500 or more employees, chances are that you have some type of a qualified plan that you're offering to employees. In fact, about 90% of employers in the private sector that have more than 500 employees offer a plan. If you look at employers with less than 50 employees, then it's less than 50% of those employers that have less than 50 employees offering any kind of plan. So you can kind of see where the gap is. If you're working for a smaller company with less employees, then you probably don't really have a employer provided plan. Well, the PEP, or the pooled employer plan that was introduced in the Secure Act, really starts to sort of helps to close that gap, if you will, in terms of accessibility for a plan that allows you to kind of have some cost sharing, things like that, because it's pooled with other employers, and certainly helps employees of small businesses and small businesses to be able to offer that. So that is big change number two in terms of 401k platforms, the pooled employer plan, allowing different employers to be able to pool together for a single plan. Number three is, of course, the push to ESG funds. Those stands for environmental, social governance type funds, where you are focusing on those as sort of the driver of the investment selection. You know that our take on those, we've certainly talked about that in the past. Not a particularly big fan. A lot of it determines, okay, well, what ESG factors are we putting in, and do I agree with those factors or do I not? What environmental factors, what social factors, what governance factors? It really is far too easy, particularly on these ESG funds, to have politics come in to the mix. And so from an investment perspective, I'm not sure you want to layer in your political view on whether something is a good or bad investment. I certainly don't necessarily want that, because, hey, my politics may be different than yours. And so why does that have to become into a factor? So our approach, stay more with funds that are more general in nature, that are more broad-based, that allow you to go where opportunities are. The reality is, though, that ESG funds are becoming much more part of 401k platforms, thanks to a new rule last October, so about 4 months ago, Department of Labor ruling designed to encourage plan sponsors to employ ESG, environmental, social, and governance parameters when selecting plan options. So again, you're an employer, you are offering the plan, now you've got to kind of roll in those factors. Specifically, the rule applies to the default option inside the plan. So oftentimes that's target date funds. So those target date funds now are going to have more non-investment factors come into play. So those are the three big changes. Rolling in annuities inside of 401k platforms, thanks to a Secure Act provision that reduced down the liability to employers to do so. Number two, pooled employer plans. That's a boon for small businesses and employees of small businesses, because certainly that is a worthwhile provision that helps to bridge the gap of how larger employers typically will have a plan, but smaller employers do not. And then lastly, this notion of more non-investment factors coming into the mix when you kind of start to look at some of this DOL rule that passed last fall, encouraging ESG factors. We're going to take a break. When we come back, we're going to talk about sort of the other thing that folks need to consider on the 401k side, plus talk a little bit about estate and gift taxes on the program next, here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So talking a little bit about some of the changes in 401k platforms, obviously hit that well in the last segment. On this segment, we wanted to just kind of add a +1, if you will, to that conversation. And that has to do with something that has not happened yet, but certainly bears watching. And that's this notion of the backdoor Roth. So first of all, what is the backdoor Roth and how do you do it? Well, nowadays, you can do a non-deductible IRA contribution, and this applies if your income is too high to do a traditional Roth, right? Because there's some income parameters that determine whether you can, in fact, just put money into a Roth or not. But the backdoor Roth sort of takes advantage of a little bit of a loophole that allows you to do conversions from an IRA over to a Roth without any view of what your income is. It used to be that your income could not be over 100 grand in order to do these conversions. Nowadays, they've sort of eliminated that. So what that means is someone that might not otherwise be eligible for a Roth because their income is too high, they can do a non-deductible IRA contribution and then the very next day immediately convert it over into a Roth. Hence, that's the backdoor Roth approach, where you wind up with the Roth, but you have to kind of do it as a two-step process, but otherwise you wouldn't be able to directly do that. Obviously, that is a bit of a loophole that certainly on the table specifically is this notion of closing down that loophole to really prevent anybody from doing after-tax contributions to have those being able to be converted. And there's a lot of conversation about that potentially starting this year in the year 2022. Similarly, to reimpose an income limit, maybe not down at the 100,000 level, maybe up at around 300,000 or 400,000 or so on any Roth conversion. So you really don't have this ability to do these backdoor Roths. Watch this one. This has been part of some of the legislative proposals that we saw last fall. Certainly a bit of a loophole that allows folks to do this in the first place. We would suspect that this loophole may very well be closed along the way at some point. So certainly that is the latest on that side of the equation that allows you to sort of do that backdoor Roth. Not a law yet that has shut that down, but certainly that is something that they are looking at changing along the way. Speaking of things that have certainly changed, when you start to talk about estate taxes and gifting, there's this common misconception of sort of where these numbers are. So there's two numbers to kind of be thinking about as it relates to estate taxes, and that is 12 million versus 1 million. So what we're talking about there is the estate tax exemption. 12 million is where it is for the year 2022. Actually, to be technically accurate, it's like $12,060,000. That's the amount of money that you can have in your estate and pass away and not have to worry about any estate taxes. Contrast that with the level of 20 years ago, which was 1 million. So obviously, the changes in the estate tax exemption have really increased dramatically to the point where less and less people are having to worry about that in terms of having to pay estate tax. So, but the confusion remains as to sort of how that plays out, because you still hear a lot of conversation about trusts and credits and things like that. And the reality is that as opposed to 20 years ago when the limit was at 1 million, then there was definitely sort of a need for trusts, or particularly a husband's trust, a wife's trust. That's typically the structure that we would see in that environment when the estate tax exemption was much, much lower. But a couple of things happened along the way, particularly this notion that was created a few years ago about having those estate tax exemptions be portable. It used to be that you had to use it or lose it kind of thing, but nowadays with portability, if you don't use it or if you don't properly set up the right structure, then you don't actually lose the estate tax exemption when the first of that married couple dies. So the rules on all of this have changed quite dramatically. Obviously, the number has increased a tremendous amount as well. Do folks still need to sort of worry about it? The answer is, well, yeah, probably, because I don't think it's going to stay at 12 million. I think at the end of the day, you're going to see that number get reduced down maybe to 3 million, maybe to 4 million. That obviously picks up a lot more people. And so certainly the conversation about estate taxes would be back on the table, but the vast majority of folks out there, they're not really on the table. When you die, there's, particularly here in the state of Florida, there's not some mechanism where you have to pay a bunch of estate taxes. So given that increase in the exemption amount, given this notion of portability, you don't hear as much of that being as big of an issue. Now, don't forget, the reason that one has a trust is if you want to have some control over what happens to the money once you pass. That's a different reason to have a trust, but generally the notion of having a trust to preserve estate tax exemptions, things like that, much less used these days as a result of that significant increase in the estate tax exemption, and as a result of the ability to have that be the unused estate tax exemption to be portable between spouses. Now, the wrinkle on all of this is gifting, because when we talk about estate taxes, it's really sort of combination with estate and gift taxes. And if you think of it this way, gift taxes would apply to a gift that you are giving while you are still alive. That's where the gifting rules come into play. You're still living. The estate rules come into play after you're dead. So one of them while you're alive, one of them while you're dead. Here's why they are referred to as sort of a unified structure for estate and gifting, because let's say you do have a $50 million net worth. You could, in fact, gift all of that so you were below the 12 million number and use that as a way to avoid the estate tax. Well, that's why the gift and the estate stuff is sort of unified, in that you're not allowed to do that. So if you were to do that, you would have to file a gift return that effectively reduces down that lifetime estate tax exemption. So that's how those two sort of interrelate. Typically you hear folks talk about, oh, well, there's a maximum amount that I can gift during the course of a year. That's $16,000 a year for this year, up from $15,000 last year. But remember, you can always gift more, and there's not really going to be any tax implications. What you need to do, if you do that, there's not any tax implications to you or the recipient, but what you need to do is you need to keep track of that. And you keep track of that by filing a gift return with the IRS that effectively reduces down your lifetime estate tax exemption of that 12 million number. So let's say you want to give a couple $100,000 to the kids to help them buy a house. You can do that, but then what you would do is you would reduce down that 12 million number down to 11,800,000. No tax implications for anybody on that, but certainly there is a filing that you would need to do in order to justify that. So know that you can give gifts of more than $16,000 per year by doing that technique. With that, we'll wrap it on up and get on out of here. This has been Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.